This is going to be worse than a housing crash, says Warren Buffett and his long-term friend Charlie Munger in an interview.
Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of what he said were bad loans as property prices fall. Please elaborate on what's going on in commercial real estate. How bad will the losses be, and what sectors or geographies look particularly bad?
But I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant.
The recent rise in mortgage interest rates to 7.31% marks the highest point since 2000. Despite this, the average home price in the U.S. remains steep, currently at $495,100. Although it is slightly lower than the previous year's exorbitant price of $552,600, it is still more than double the average price of $212,100 back in 2000. These unusually high interest rates and exorbitant home prices are far from normal. Typically, when interest rates are dropping, it is favorable season for home builders to thrive. However, this situation is raising concerns among experts who believe we may be headed towards a housing market crash in 2024. It appears that history is repeating itself, which is definitely not a promising sign. Between the summer of 2006 and 2012, the United States faced its most significant housing decline since the Great Depression. This wasn't just a local event. It had global repercussions, triggering a severe recession that affected countries around the world. Back in 2008, Buffett accurately predicted that the housing market crash happened because of greedy investors taking big risks with borrowed money. Now he's pointing out that the same kind of risky behavior is happening in the real estate market. Buffett is concerned that investors treat real estate like a high-stakes game, using a lot of borrowed money and focusing on quick profits. And it's risky because just a few transactions often determine the value of properties. He's not optimistic about the future, suggesting that what's coming might be even worse than the 2008 housing crash, hinting at some tough economic times ahead. While historians, analysts, journalists, and filmmakers often focus on the crash itself, what often goes unnoticed is the period before the decline, the bubble era. It's often characterized by a slow increase in home prices, which suddenly begin skyrocketing in the following years. Between 2002 and 2006, real estate became the epicenter of a modern-day gold rush, with prices soaring daily and leaving buyers frustrated, confused, and angry. If this scenario sounds familiar, you're not alone. For many of us, it's hard to ignore the parallels between then and now. After the 2012 crash, real estate prices gradually rose, and then, spurred by the events of 2020, they exploded. Many people can perceive that something is off in this market. It's far from normal. In other words, what we're experiencing right here, right now, is the new bubble. We're seeing a housing bubble that's strikingly similar to the one in the early 2000s. And it's making history look like it might repeat itself. The real estate market is getting pretty wild, especially in hotspots where speculative investors are causing big price swings. This could turn the housing market into a roller coaster, leaving many people feeling frustrated and uncertain. Looking back, it seems like we're entering the final stage of this bubble, a stage marked by speculation, investments, and greed. It's a familiar pattern that history has shown us before. Warren Buffett is sounding the alarm about the real estate market, saying it's like a bubble ready to burst. He warns that the current situation is far from normal and that we're in a new bubble. Charlie Munger, Warren Buffett's late partner, left us with a serious warning about the commercial real estate market before his last annual meeting. He saw trouble brewing, a storm that could hit the banks and have a ripple effect on the entire market. Before the last housing crash, quite a few people sounded the alarm about the impending disaster for the housing market. Despite what Hollywood might portray, it wasn't just one lone individual who saw it coming. In reality, numerous notable investors and even regular folks were well aware that the market was sitting on a massive bubble just waiting to burst. Among those voices of caution was the legendary investor Warren Buffett. At the 2006 Berkshire annual meeting, which happened very close to the peak of the last housing bubble, someone asked Buffett about residential real estate. Warren not only pointed out the dangers, but also accurately highlighted that it's not the regular people who are at fault. The real culprits are speculative real estate investors, using extreme leverage and operating with greed, a lethal combination that he correctly predicted would lead to a collapse.
some of the sin that was in the manufactured housing finance a few years ago has shifted into the finance of the stick-built houses. There is a lot of ridiculous credit being extended in America in the housing field. It had a horrible aftermath in the manufactured housing sector, and my guess is there'll be some trouble in the stick-built sector in due course.
Well, dumb lending always has its consequences, and usually on a big scale because you don't see it for quite a while. So therefore, it's like a disease that doesn't manifest itself for a few weeks, and you can have an epidemic of something like that, and by the time you know you have an epidemic, you're very well into it. Well, that's what happens in dumb financing, and you had that. You periodically get it, but you certainly had it in commercial financing in the 80s, and you had the RTC and the savings and loan crisis and all of that, because literally one dumb project was put up after another. A developer will develop anything he can borrow the money against. I mean, it's that simple. And when the lending institutions pour the money out for something, it will get built.
During the May 2023 Berkshire Hathaway shareholders meeting, Munger pointed out the buildings don't go away, but the owners do. It was his final annual meeting, and he expressed concern about the hollowing out of downtown areas in the U.S. and worldwide. He predicted that while the U.S. economy might weather the storm eventually, commercial real estate would end up with a different set of owners. Listen to what he had to say.
That from time to time, even in great localities, you've seen it happen in New York a couple of times, in the last 30 years, where the swing in properties values has just been huge. And what we see in our residential brokerage business, and we're in I don't know how many different states, is we see a slowdown every place. Now, we see it most dramatically in some of what have been the hottest markets. And the markets where you're going to, in my view, you're likely to see the greatest fall off and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use. $100,000 for a house and mortgage it for $270,000, and if the value goes to $250,000, if they have a job and everything, they won't move out. I mean, you don't lose a lot of money, even though the market value on a given day is less than the loan value when families stay together and employment is present and all that. But when you have investment type holdings or speculation type holdings, when you in effect have had the day traders, of the internet move into the day trading of condos, then you get a market that can move in a big way. First, it sort of stops, and then it kind of reopens.
In his response, Warren Buffett is particularly focused on investors who have transformed the real estate market into something resembling the penny stock market. As Buffett notes, these investors are using leverage excessively and are heavily involved in quick flips, almost like they're day trading on their computers. If you take a look at the data from the past 2 years, you'll notice a significant surge in investor activity, reaching unprecedented levels. Many of these investors are employing speculative funding methods that often go unreported. This includes taking on risky loans and even engaging in fraudulent loan practices. Charlie Munger later pointed out that it might not be the best time for investors to invest in commercial real estate. He pointed out that commercial real estate works better for taxable investors than for corporations taxed the way Berkshire is. Instead, Berkshire Hathaway is steering towards a more promising venture, residential property development. In recent months, they've increased their stakes in major home builders like D.R. Horton, Lennar, and NVR. The expectation is that a potential boom in home building could bring significant benefits to these investments. For those looking to tap into this potential growth, retail investors can explore publicly listed home builders or consider the S&P SPDR Home Builders ETF, parentheses XHB. It's a way to participate in the residential property market, which is showing signs of strong potential amid the current real estate landscape. Moreover, echoing Warren's observation, the real estate market is an extreme example of the law of the vital few. Unlike stocks that trade on a live market from Monday through Friday, providing a constant look at prices, homes sell based on comparable sales, often relying on a very limited number of transactions. As you may be experiencing now, you might think your home is worth a certain amount because someone nearby sold a similar home for a particular price months ago. However, this method is a poor way to measure value, making the market susceptible to significant and rapid shifts in both directions. Just a few unfavorable sales can quickly redefine the value of an entire neighborhood. Crashes in real estate can indeed happen suddenly and seemingly out of nowhere. As Warren Buffett points out, investors only need one person to buy at their price, and given the high real estate prices, there's a constant element of hope in the market. Just one buyer can keep an entire neighborhood afloat. However, the descent can be swift once news spreads about a downturn. Investors rush to get out as soon as they sense the market is slipping. This behavior was vividly evident in various markets in 2007. Take Phoenix, for instance, where prices fell over 5% in a single month during many months. Imagine a $300,000 house losing over $25,000 in value within just 30 days. In the dark days of 2008, a typical home in Phoenix lost 37% of its value from March 2008 to March 2009, a staggering decline within a year. And that's just a metro-wide average. Specific neighborhoods faced even more severe damage, with homes losing over 60% of their value in a year, wiping out the investors who had purchased them. The recurring pattern here is that the bubble-like behavior, characterized by a massive price surge, is often followed by some form of implosion. The root cause, time and again, is attributed to the actions of greedy individuals. Today, we're witnessing a similar scenario. Investors obtaining loans to buy struggling Airbnbs, engaging in money-losing flips, and investing in negative cash flow rentals. It's a familiar story repeating itself, emphasizing the cyclical nature of real estate markets and the potential risks associated with speculative behavior. At the end of the day, the bubble we're witnessing now is a lot like the one in the early 2000s. Sure, the details might not be identical, but you know how they say history doesn't repeat itself? It rhymes. What's fueling this bubble are bad loans supporting speculative investors in hotspots all over the country. It's causing those wild price swings we've seen in recent years, and this huge peak is bound to take a nosedive. As we mentioned earlier, the tricky thing about housing crashes is they don't usually happen gradually. When the market flips, it does so suddenly, making this long, miserable climb up quite frustrating. The steeper the climb, the more tempted we are to think the other side of the hill will be just as steep. Thanks for watching. If you find this video helpful, kindly give it a thumbs up and subscribe to this channel for more videos that'll help your financial life. See you in the next video.